Hello, I hope you're well. In the last video, we looked at some of the basic concepts related to the share market. In this particular video, we are going to understand what does a shareholder earn when he invests in shares. So there are basically 2 to 3 things that a shareholder gets. One is the dividend, number 2, bonus shares, and 3, capital gain. Let's understand what each of this means one by one. Let's first look at what is a dividend. Dividend is nothing but distribution of cash to shareholders. So basically, company is giving a part of its profit in the form of cash to the shareholders. And remember, in the last session, we had said that shareholders are owners of the company. So basically, in the form of dividend, these owners, that is the shareholders, are getting the profits in the form of a dividend. Now you may have a question, how much dividend do you earn when you invest in the companies? So that is totally dependent on the company. There may be some companies who may pay you 100%, 1000%, 5%, 10% dividend, or there could be certain companies who may not pay you any dividend at all. Now you may feel, is there any company who does that? Yes, there are many, including companies like Apple. Why would a company do that? It's quite simple to understand. So let's say when you get a dividend, as an investor, what are you going to do of that dividend amount? You will invest it somewhere. Could be in a deposit. You could invest again in shares. You may invest it in mutual funds. And then the return that you are going to get would be in a certain range. Let's assume 10%. Now the company feels that instead of giving you that dividend and you investing it, if the company itself invests that amount in the business for the growth of the business, then it will be able to give you a much higher return as a shareholder, as an owner. In that case, the company may decide not to give you any dividend. So basically, dividend is optional for the company to pay. Most of the companies in India will pay you a dividend. Remember, it is optional. Now coming to the next point. You would have heard that many companies give a dividend of 100%, 1000%. So what is that 100 and 1000% given on? Is it on the market price of the share? Amount that you've invested? What exactly do you get this 100% on? So remember, you get this percentage on the face value of the share. Let's now look at what is the face value. In very simple words, face value of a share is nothing but the listed price of a share. And every company is free to determine what should be the listed price of the share. So generally promoters or the founders of the company, when they establish a company, they specify that what is the face value of the share that they want. So it could be 1 rupee, 2 rupee per share, 5 rupees, 100 rupees, it could be absolutely anything. It depends on the founders or the promoters of the company. So when you get this 100% dividend, it is paid on the face value of the shares, not on the market price or any other price. I'll just show you one interesting company. In fact, there are many like these. This is very interesting to note that how much can a face value be different from the market value. So let's look at the share of MRF. If you look at the shares of MRF, the price of one share of MRF is somewhere in the range of 70,000 per share. And what is its face value? So if you look down, the face value of one share of MRF is 10 rupees only. See, market price of one share 70,000 and its face value 10 rupees. And now when the company says that I'm going to pay you 100% dividend, company is paying you nothing but 10 rupees. Another point to note, when you get this dividend, you have to pay tax on it. So dividend income is taxable. Apart from that, like I said, the shareholders could also be paid bonus shares, that is additional shares by the company. However, payment of bonus shares does not happen frequently. Apart from that, what a shareholder earns by investing in shares is capital gain. Of course, the capital gain would be realized only when you sell the shares. So what's a capital gain? Let's first understand that. Capital gain is nothing but the profit that you are earning by selling the shares. So let's say if you buy the shares for 10,000 rupees and if you're selling them for 15,000 rupees, then 5,000 is going to be your capital gain. But remember, due to the stock market volatility, if you sell the shares below the acquisition value, you may also incur a capital loss. Right? So capital gain is applicable only when you sell the shares at a price higher than what you purchased it for. If you sell the shares within 1 year of investment, then you earn short-term capital gain. Whereas if you sell the shares after 1 year of remaining invested, then you get a long-term capital gain. Now you may feel, how does it matter whether it is long-term or short-term? So it does matter when it comes to taxation. A short-term capital gain is taxable at 15%, whereas a long-term capital gain up to rupees 1 lakh is not taxable at all. Beyond 1 lakh, if you have long-term capital gain, then it would be taxable. So overall, these are the kind of benefits that you get when you invest in shares. I hope you found this session useful, and if you want to see more videos like this, do subscribe to the channel. Also, if you want me to cover some specific topics, do not forget to tell me in the comment section. Thank you.